Okay, right. I think we'll get started. So Eleanor, thank you so much for joining me today on I think this is our 4th webinar now. So it'll get very exciting. So a bit of background. Ella and I started working together last year on basically this new financial health check service that we've just launched. And we were chatting the other day and thought, actually, there's so much that the business owners sort of have learned just from going through this process. So we thought, well, actually, why don't we do a webinar just sort of explaining, how people can do, like a mini health check themselves if they feel comfortable doing that. So we'll kind of give you some pointers as to what to look out for. And obviously, if you did want to sort of get us to come and take a look ourselves, then yeah, we'd be more than delighted to do that and stay on till the end of the webinar because we have got a special offer on that. So, but without further ado, I'm gonna hand over to Eleanor to answer the first question, which is, why is financial health so important for small businesses?
I think it's critical for most businesses, not just small businesses, but I think that today in the media really emphasizes those 1 in a million cases where a business keeps going or it gets sold for multiple times its revenue despite making trading losses. But that's just not the reality for most businesses. Most businesses need to be healthy in their finances in order to keep going, to keep meeting their liabilities and to keep growing and achieving those ambitions. So having healthy financials in terms of your profit and your cash is just crucial to being successful with your business.
Yeah, no, 100%. And you've been working with businesses sort of in the FD capacity for sort of 10 plus years. So you've come across a lot of business owners, and obviously doing this financial health check with sort of experienced a lot of people's sort of misconceptions of about their financial health. What do you think the common ones are that they come up with?
I think there's some really common sort of false securities. So it's very common these days for a business to have an accountant, which is fantastic. They'll help you with all your filing, compliance, etc. It's worth noting there is a difference between an accountant and a bookkeeper, which I think many businesses don't realise. But also, just having an accountant isn't going to guarantee healthy financials. They are unlikely to give you input into the commercials of your business, to flag risks or opportunities even. They are there to do their job, which is to file your accounts. They are not necessarily there to help you be the most profitable business that you could be. And another really common one is there are some great business owners who are all over their P&L, but they don't look at their balance sheet. And I think you did a webinar recently with Ramsey on the importance of your balance sheet, because if you're not looking at your balance sheet, you just can't guarantee that P&L numbers are correct. And then you're sort of wasting your time looking at the P&L if you're not looking at accurate data.
Yeah, no, 100%, 100%. And I guess, like, talking about accurate data, what sort of what would you say are the key financial metrics that every business owner should be tracking regularly, and also give some guidance in terms of when they should be tracking them, I guess, or how frequently?
It's just going to vary so much, not just by industry, but also by business. So I think the key things about metrics is you want to track metrics that are useful, that are actionable, that are levers that you can pull in your business to improve it. So it's about, rather than sort of standard, this cost line should be this percentage of sales, it's about what's really critical to your business. So in e-com, you might want to monitor your cost per click, and get that down. And so I try to increase your traffic, but reduce the cost of that traffic coming to your business. If you're in a logistics business, you might want to reduce your cost per order. So it's really looking at what are the key factors that make up your revenue, your margins, your profit, and what metrics can you create to track that where they're comparable, where they should be easy as well to pull from your data, and where you can actually take an action when you look at them and say, hang on a minute, this is lower than last year, we need to adjust something.
And are there some metrics that you should be doing weekly and some metrics that you should be doing monthly, would you say?
Again, depending on the business cycle, I think if you are a trading business where you're selling a product, then a weekly trade meeting looking at your key KPIs, your revenue, conversions, your discounts, your returns, that's definitely makes sense. Other businesses might have more of a monthly cycle. They might be on a project basis, and maybe there it's at mid-month or end of month, looking at your time utilization. You know, it's really unique, and that's kind of why I love working with these small businesses, is because one template doesn't always fit all, and yeah, it's all, everything we do, including the financial health check, is really tailored to the specific needs of those individual businesses.
Yeah, no, 100%, 100%. And you know, what role would you say sort of profitability and cash flow play in assessing the overall financial health of the business? So you sort of mentioned profitability previously, but yeah, the cash flow element as well.
Yeah, I think that sometimes businesses can feel quite confused with the cash flow element. And I don't think finance directors help with this, because it can be very overcomplicated. You know, I mean, ultimately, it should follow the same direction as your P&L. If you are making a profit, you would expect to be generating cash. The things that would fall outside, things like capital expenditure, investment, these are the things that are going to make the difference that you need to watch with your cash. They're definitely not the same. And there's a big impact in timing as well. So when you look at your P&L, you're looking at your net sales and thinking everything's going smoothly, but you've got a VAT return coming up that's sitting on your balance sheet. And so a cash flow kind of links everything together. It links everything that you're taking in with what's going out. And you want to be really mindful of this, because the last thing you want is to be in a position where you don't have that cash balance and you can't pay your creditors and your suppliers or your people, and you're there panicking and talking to the bank, trying to get an urgent overdraft extension or a loan, or worse, you're being approached by those very attractive, easy access, short-term loans that will trap you into a vicious cycle of really high interest rates. So I think monitor your cash flow, have a view of the forecast, and just avoid being in trouble.
Yeah, and I think we had a visual to share there, didn't we? In terms of just bring that up. You can see that. Is that coming up, Eleanor?
Yeah, we can see the first slide.
Okay. So basically, this is just to demonstrate, well, I'll let you talk it through, but it's to demonstrate a profitable company, essentially, albeit a very profitable company. We were discussing this morning. These figures are made up.
So not all businesses, some will, but not all businesses will have an operating margin of near 50%. If you're unsure if you're making a sort of standard industry profit margin, please speak to Kate and I, and we can give you some assurance or flag any risks. But yeah, this is a highly profitable business, and it's just showing, you know, we've got a strong margin and we've got a strong profit. That's what we're all aiming for. Maybe not immediately, but at least in the near term. And then this slide is about a profitable business. So you can see the cash coming in is greater than the cash going out, and they are on, I believe, 30 days payment.
This is the 30-day payment term. So it's basically saying if you're getting your money in bang on 30 days, then actually that profitable company that we showed on the previous slide looks like this. And then this next graph is basically demonstrating same company, but then they're on 90-day payment terms. So like hopefully that can like really bring home the point. Nothing else has changed. The cost base hasn't changed. It's exactly the same numbers, but this is just to show the sort of the cash flow effect of like literally just changing that one dimension, which is changing it to 90-day collection, which yeah, I just think it's really powerful in terms of sort of reiterating what you were talking about there.
Absolutely, yeah. You can see how pushing out that time of accessing the money from your customers really does impact your cash flow. And this is really common for businesses. It's not necessarily that you're always giving your customers those extended terms that leads to cash flow timing impacts. But many businesses, you're having to incur outlays, whether it's to purchase materials or invest in machinery. You're having to do this before you're selling, before you're getting that money from the customer. So a lot of businesses will face that sort of working capital cycle challenge. But there's so many ways to address that, that you shouldn't feel like it's hindering you from growth or from achieving profit.
Can you maybe just go through sort of some of those options? I mean, obviously the obvious one is the overdraft, but for one of our clients that came out of the financial health check, you've been doing sort of a lot. I must reiterate as well, we're not financial advisors, but we can sort of do research and then sort of point you in the direction of a financial advisor that can actually then give you the finance. But Eleanor, you've done a lot of research on this recently.
Yeah, there's so many options out there. And I think the important thing is if you've tried to access financing and you've not got it, you might just be going after the wrong one. So there's lenders that will loan based on assets, there's lenders that will loan based on revenue, based on cash flow, based on forecasts. There's not sort of only one style of lender, and if you're not profitable, they won't give you the money or they'll charge you really high interest rates. A lot of the time it's about telling the story of, okay, this is the problem we need now, this is why we need the money. And I think that's where having a fractional finance director is really useful to kind of put those numbers into context to be able to tell that story. But I'm working with a really great funding broker at the moment. And again, they just have a lot of specialist knowledge in terms of the regional schemes. There's things like government-backed schemes, like the growth guarantee scheme. There's a world of options, but not everybody has the time to go and investigate them all, and they're confident that they're getting the best deal. And sometimes you can get into situations where there's a personal guarantee, or like we've said before, these really high interest rates, or you find out you can't pay it back early. So you want some support with that, I think, to have that assurance that you are being financed in an optimal way, but also that there's a route out of it, so it's a temporary thing.
Yeah, no, 100%. And I guess apart from getting those high interest loans that we see business owners sort of make a mistake on, what are some of the other common financial risks that the SMEs face, and how can they be mitigated?
I think a really common one is growing too quickly. It's really exciting when as a business you have opportunities and you always want to say yes to them, but you need to be smart with how you grow. You want to have the right foundations, and you want to be taking on opportunities that have synergies in your existing operations that will have halo effects for future operations. And if you focus on how you're growing rather than how much you're growing, I think if businesses start to feel like they've taken on too much, like something is feeling tight, like they're feeling under-resourced, it's probably time to look at your model, to look at your cash flow, to look at your profit, and just take a step back and think about, where do we want to be in 5 years, and are we making the right steps now to get there?
But so this is a common problem, I guess, in terms of how do you know if you're excuse me, if you're excuse me, how do you know if you're growing too quickly? I guess, what would you recommend? I mean, you sort of said about margins being tight, but how would they know that?
I think if you want to have a sense of control. You want to feel like you're comfortable with how the business is performing. And really one of the best ways to do this is to look at your numbers. Looking at your profit, understanding where did we expect to be. This is why budgets are so important, because you could be down this month, but actually it was planned for, and you plan to go up next month. So where did we expect to be? Where are we? Are there any variances, and what's driving them? Because those could be your red flags where you're saying, are we growing too quickly? And It could be that suddenly your staff costs have way over budget, and perhaps that's because you've taken on a bit too much, and you need to understand if that's sustainable. But also, I think the other ledgers as well, are you on top of your debtors? Like sometimes businesses grow really quickly, but they're not getting the cash in, which goes back to that slide that you showed, where you're waiting for the money. And that can be a big challenge for businesses. Looking at your creditors list, are you paying your suppliers on time? Have you got a big backlog? This is not going to be reflected in your P&L. So you want someone who can bring all of those things together for you, or to train yourself, looking at your bookkeeping software, looking at your reports. It's all there, and it's very accessible, but it's so important to look at.
And just on that, I think handily we do have another slide just to, now this is, I don't know why it takes me back right to the beginning. It's really quite irritating. Anyway, here we go. So yeah, this is an incredibly simplified age receivables. This is another thing that is also confusing. It's like, age debtors ledger, age receivables, trade debtors. It's basically all the same thing. But yeah, this is, Eleanor, if you want to sort of just quickly talk through in terms of if someone did want to try and gauge the health of their finances themselves, this is one of the reports that you could ask for.
Absolutely. So I think, the first thing is you've got debits and credits in this. You've got positive numbers and negative numbers, and that would flag that perhaps things aren't being well managed. Perhaps things aren't being matched off. Perhaps there is a bit of confusion in what's owed to you that you need to get clarity over. And then you've handily highlighted all of those older receipts that are still expected. And as I said in the beginning, you want to think about how you're expanding and which customers you're taking on, and make sure you're doing credit checks and make sure that those are going to be reliable payers, or mitigating for the risk that they might not be. You can't build your business assuming everyone's going to pay you exactly on time in 30 days, because that's just not always, sadly, how it works out.
Yeah, no, 100%. Right, I'll just stop sharing that. And in terms of, you spoke about there doing sort of credit checks on customers. What would you recommend, in terms of, do you do that on every new customer, or what would you, I know, on the financial health check, you handily used your subscription and did it on a few of our clients' customers.
I would want to do a credit check on every new customer in a B2B environment. I think it should be part of your customer setup. I would also consider doing it for your suppliers as well, because you don't want to find any sort of concerning background there. So I think, it's an important step, and there's systems to do it. If you don't do it on all of them, I would say at least look on Companies House and see their performance, because that might also give an idea of the risk. If they're making massive losses, you might not be able to count on them as a reliable customer.
Yeah, and that goes back to that webinar with Ramsey, where we sort of showed, because you can't, if it's a small company, you can't see a company's P&L, but if you look at the balance sheet, historical balance sheet of the financial statements, and if that's got a negative retained earnings figure, that indicates that there have been losses. We might need to be a bit wary of. So that's kind of a good point to. Also, something else I just thought of it, just in terms of like a good financial control, and not many of our customers do this, but one of them in particular, if they're doing a payment to us, they will then phone up to just double check the amount and just check it is a legitimate payment, in case someone has intercepted the invoice and put their own bank details on. So
it really does happen. Yeah, that one for me is the most concerning, that you could receive an invoice that looks completely legitimate, that's got the logo on, that's got the bank details on, but it's been intercepted and those bank details have been altered. So that's why we have controls in things like payments, in approvals, in banking uploads. So it's a good one to bring up to spread the awareness of, for sure.
Yeah. And we've sort of touched on sort of a couple of pointers there, but what other practical steps could a business owner take to improve their financial health?
I'll just answer Steph's question. So
Yeah.
she said, would you call every time or just if bank details have changed? I think if I would call the first time and I would get verbal confirmation that those bank details are correct. So I would call a public phone number that's available on their website to make sure, rather than someone's mobile they've given you. And then I would trust that they've stayed the same. I wouldn't call every time, but if they've changed their bank details or the invoice comes through with different bank details, at that point I would want to stop, not pay until we've checked that. And in terms of other things that businesses can do from their controls, I think it's things like double approvals. If we're talking about banking, I do sadly know of several cases where there has been internal fraud, and it's from people that you would never expect, from people that you would completely trust.
Really?
But there's also controls that should be in place to guarantee, or as close to guarantee, the accuracy of your numbers. So this comes back to reporting, and it comes back to things like having controls over the valuation of your inventory. If you don't have, and this is just so common, if you don't have the right cost of goods value, then you're not looking at a realistic profit margin. And I think that another reason that we come back to profit again and again, it's not only about having a sustainable, successful business, but many of the smaller businesses that we work with are director-led, and those directors will be paying dividends to themselves, their shareholders, and you've got to be quite careful because you only want to pay them out of your available profits. So again, you really need those profits to be accurate, or you could end up with quite a big bill from HMRC on repaying withdrawals that you shouldn't have taken.
Yeah, that's a really good point. And I guess in terms of sort of other tools and resources to give a business owner sort of better sort of financial visibility and control, what else would you suggest? I guess in terms of the visibility piece.
Right, from visibility of their numbers.
Yeah.
Everything is there for them. As long as they're using a bookkeeping system, they, I promise, have accessible reports that are there to tell them what their customers owe, what they owe their creditors, what their profit is. The key is looking at them on a regular basis so you can see the movements and that you understand the movements. Oh, that makes sense because we purchased more inventory. Well, that makes sense because we hired that extra person. And when you can't explain the movements, there's a problem.
Yeah, no, 100%. And then I think also sort of talking about sort of the weekly trading reports and stuff like that.
Yeah, so I think we were talking so much about numbers, but really what people respond to are visuals, or
visuals.
I hear all the time, just tell me thumbs up or thumbs down. Green light, red light. And that's, again, where your fractional finance director can help build a dashboard that's really understandable, that you look at and you instantly sort of can see, okay, we're up this month, we're down this month, we're on track, we're not. And that's invaluable. That just saves you the trouble of having to untangle numbers and decipher all these financial statements.
I think handily I've got some little visuals to sort of demonstrate on that you've handily prepared before. So yeah, so that's kind of sort of one of the things that you're sort of talking about there.
So this is a services company. And as I said in the beginning about KPIs, some of the things that they were looking at would be their cash balance was really important. You could see they're making a big investment there, and they needed to track that was not going to put them into a negative position. So this graph every week updating, looking at the forecast of cash, are we still okay? Looking at their debtors, looking at not just their monthly revenue versus budget and last year, but also their full year target, because things can fluctuate so much. And then the metrics that were more specific to them. So how many hours do they have in theory available? Are they working? And how many of those hours were billable? And what's that sort of target? Because sometimes they might be doing admin work, they might be chasing new business. But this business had a specific idea of what they wanted their utilization rate to be. and then the win rate of new projects. So these are really actionable. If their utilization is lower than what they think, then it might not be a problem, but you just need to understand why and make sure that's built into your business model going forward. If they're not hitting all of their projects, or if they are hitting all their projects, both of these cases should be looked into. Why not? Or what are we doing really well that we need to continue doing? Should we start targeting bigger projects? I think, you want to look at things that are really relevant to your business, and having them laid out like this in a visual way will get everybody invested, because everybody hopefully will be able to understand where they are.
Yeah. And then we just got some other examples of the sorts of things that you would recommend as sort of standard practice in the finance function.
Yeah, management accounts, which many people will have heard of. So what comes out of systems like Xero and QuickBooks is really useful, but it is down to the business to sort of determine the best way for them to present, for them to consolidate the cost lines. What is cost of sales for that business? In this case, this was a services business, but they did have a cost of sales because they were purchasing things for those projects. And yeah, just making sure that each line is really relevant to you, and that you do care what's in it, and you are tracking the ups and downs compared to both budget and last year. And I think the reason that we track against both is just that you might be down on budget, but your budget is also likely to have been driven by perhaps growth on last year. So looking at the both, you can see, oh, okay, we're missing budget, but we are ahead of last year. So perhaps budget was a bit ambitious, and where did we sort of overestimate things? But you also might be down on last year, and then it could be more about the external factors. It could be economic climate. It could be your efficiency has reduced. So both of those are really important. And Steph has asked a question. Would you include a full year forecast, and how often would you update that? I would do a budget at the beginning of the year. And then I think, depending on that business's cycles, it's probably ideal to have a quarterly reforecast. If things are changing a lot, you could bring that to monthly. If things aren't moving a lot, you could bring that to half yearly. But a quarterly reforecast is really useful if you are a bit away from your budget, and you want to sort of know, okay, now where are we expected to land? And if you are involved with third parties, like you have got a bank loan, or you have got an overdraft, or you are being financed by someone, you'll want to be able to explain the difference to that budget, which is where you've set the expectation. And they are going to ask you, okay, well, now where do you think you're going to go? So it's not just of internal use to say, well, this is more likely where we're going to end up, and this is what we really need to consider. And actually now maybe we do need to target our costs, or maybe we do need to be looking at our cash flow. It's also externally. You need to be able to explain your numbers and make sure you're setting the right expectations.
And then the last one was just the sort of cash flow forecast, where you've got your sort of your actuals for the first 3 weeks, and then you've got the sort of the forecasts going forward.
Yes, it looks so simple here, doesn't it?
It does. So much work that goes in behind it.
Yeah, I mean, I think the reality is, if there's any business owners here who are thinking, well, we look at our cash flow, but it's rarely correct. I mean, there are a lot of assumptions that go into a cash flow. There's a lot of timing differences that can happen. It won't always be accurate week to week, but it's the trends that are important. And if you have nothing, you're flying blind. So you really are just open to so many risks. So I think, look at the trends, and it's an evolving thing. If you are off for 1 week, can you course correct? Can you look at how you might reforecast going forward? But it's so important to have.
Yeah, 100%. Right. I will stop presenting again. Fantastic. So I guess if they're businesses that aren't sure of where to start, what would you say is the best first step for them to take? You sort of covered some of this here, but just sort of reiterating sort of maybe some of the stuff that you've already said.
So the reports are there, they're in your system. I think if you could speak to your accountants, you can speak to your bookkeeper, you can say, hey, I want to see my P&L. But of course, I would also say, come and speak to Kate and I, and come and decide if a financial health check is valuable to you right now. The sort of things that we've seen from the health checks that we've done have been, there was a business which was quite clearly, when we looked at the numbers, sort of overstaffed, and we could see that that was headed to a very difficult position for them, and so we did flag that as a risk to their cash flow and their viability. But they were winning a lot of projects and getting a lot of opportunities, and I think we wanted to encourage that as well. But as they were growing in that sense, it was kind of maybe some compliance and controls falling behind, maybe some misunderstanding of bookkeeping, of misunderstanding of how important the balance sheet is, and this sense, that the business owner had of, well, we're growing, this is great, the business is obviously successful, but actually not seeing some quite big liabilities on their balance sheet that they were going to crop up at some point. So with the financial health check, it just takes the pressure off the business owner from doing all that legwork. We can do it for you. We can look into your controls, your compliance, your reporting, your performance, and summarize the biggest risks and recommendations that we would suggest. Another business that we've done, completely different industry, was in retail, and they were struggling because they had paid their VAT bill. They were really struggling with cash. But for them, the future was bright. Like, they had an excellent forecasted outlook. They'd made really big changes on their own based on reducing their costs. They knew something was wrong. So we have pointed them in direction to obtain some financing, what could be right for them, what could be wrong for them, and just helped them to, they had strong accounts, but they didn't have a narrative. So they didn't have the tools to communicate all these incredible changes that they'd made and why their business was now profitable, to get the best deals to help them in this interim period and continue growing beyond.
And I guess if anyone is interested in sort of going for our health check, obviously, this is just something we launched last year, so we're still, it is still evolving, but we feel pretty well. We've had amazing feedback so far, but it would be great to just sort of run through, what is involved, from a business owner's perspective in terms of, the requirements.
I think the idea is to make it as easy as possible for business owners. So we try to extract all of the information that we need from them in one meeting that wouldn't go on for longer than an hour. We set up a SharePoint where they can drop in any requests that we've made that we might not have access to, but as long as they can give us access to their bookkeeping systems, most of the information we can get ourselves. So what we really need from the business owners is just to tell us their story about how their business works, where they see it going, any concerns that they have. And it's such a pleasure to speak to businesses, to speak to these small businesses who are all, sharing this entrepreneurial spirit and making something work. I think we have had a couple where we've said, actually, the financial health check probably isn't for you.
Yeah.
And we've pointed them in the direction of where they could get better advice. In those cases, it was very clear from that initial conversation, and it was about where they were struggling with particularly technical pieces. And I think Kate and I, we're not going to be tax specialists. We will tell you where we see risks, we'll tell you where we see recommendations. But if you're looking for a particular technical detail on R&D, we will help you find the answer. We can point you to the right direction. We can tell you if we think it's important, if we think it's not important, and how you can get there. And that can all be accessed from those conversations with us before committing to a financial health check.
Yeah, because I guess so the first hour meeting is free essentially for us to assess, if it's right for you. And one of the ones that didn't go ahead, they'd had like sort of a thorough due diligence because they got investment, and then that investor wanted an external person to do due diligence on the business. So they'd kind of pretty much already done the exercise that we would be doing. So it's not right to then sort of take any money for that. But yeah, on the ones that we have done, well, we've thoroughly enjoyed it, haven't we? And at the moment, well, we personally feel it's a bargain because we're spending between us probably over 20 hours, which equates to a normal charge out rate of like £3,000. And yeah, we're sort of offering for the first 10 customers the financial health check for £1,075. So yeah, and I'm sure I can do a discount for any Goldman Sachs people who come to me. So, but yeah, if anyone is interested, then do contact me afterwards. So that's the sales plug done on that.
No, I mean the feedback has been really, really great. Like it's been quite overwhelming how positive people have been and how much they've got out of this health check, and having someone just summarize, this is the of everything we've looked at, these are the key things. I think they've just said that's been really, really helpful. Like the phrase that comes up a lot is you don't know what you don't know. And a lot of these business owners just don't know. It's not that they're not capable. It's not that they don't have it. It's just they just don't know that those are the things they should be looking at. And I think, I was quite nervous doing a webinar, but I contacted an esteemed friend and mentor. And she said, this is really valuable to businesses. And if you don't do this webinar, you don't advertise it, there could be business owners missing out on something that could be pivotal to their success or failure. So that that was really encouraging. And
it does. It turns it around, doesn't it?
Yeah. And that's definitely the satisfaction that I'm getting out of it at the moment. Is it's not just looking at bookkeeping, it's not just accounting, it really is a holistic view of the business. And we really are on your side. We're trying to support you achieving your goals, your ambitions. And for that period of the financial health check, your business is our business. Like we want what you want. And that's the goal ultimately, is just what could be getting in the way, what could you not be seeing, where are the blind spots? And what we can reassure you that you're doing really, really well as well.
Yeah, fantastic. Good. Well, I'll just have a look to see if there are any more questions. I don't think there is. Take us put something in there, but unless anyone else has got anything that they want to ask, now is your time. Free consultation with Eleanor. I mean, just as another example, you don't know what you don't know. One of our clients, I was talking about, journals and the difference between the accounts that tie into the statutory accounts, so the ones that you have to submit to Companies House, the accounts that that we got presented from the external accountant versus the accounts that are on the client's accounting system. And then I started speaking about having the accountant having done journal entries to make adjustments from the accounting system to the accounts that then tied into the statutory accounts. And the client didn't understand the phrase journal, because that is an accounting thing, and it's basically just the way of adjusting the books that are in your system to make them accounting correct for accounting purposes. So sometimes things won't get posted correctly, so they need to be amended for statutory purposes. We should probably do a blog or a webinar just purely on accounting journals at some point, but it's stuff like that you don't appreciate, that clients don't necessarily understand, because it's just the daily language of an accountant, I guess.
I think a really common one that gets overlooked and is so quite an easy concept, I think, to get are the accruals and prepayments. So in accounting, you would want your each month to reflect the revenue that you've incurred, you've obtained that month, but also the cost that you've incurred. And when you get a bill or you get an invoice, it's just going to go through on that date. And so you would need to post a journal to move, say, a cost that relates to March into March. Or you might have prepaid something. You might know that you've got something coming in March and you need to move it into March, even though it's going to be paid in April. So this is just a really, really common journal. And the reason you do it is not just to appease the statutory accounts. It's, again, that idea of, were we profitable in March? It's like, oh, yeah, we were. Oh, except in April, we incurred a £50,000 marketing fee that we didn't accrue for in March. So actually, when you put that in place, it doesn't look as good. So this is why you have bookkeepers. This is why you do journals, why you have accounting systems, why you look at your P&L.
Yeah, that's a very good point, actually, that journals aren't just to do the bit for the statutory accounts. It is actually to account for things correctly on a monthly basis as well, like you say, mainly for prepayments and accruals. So yeah, and I've done a couple of blogs on those as well, I think. So anyway, I think time's up. So thank you so much for your time today, Eleanor, and everyone who's attended, and hope it's useful. And please do get in contact if we can be of assistance. So thank you. Really appreciate it.
Thanks, everyone. Bye.